Welcome to the second part of the explanation of the personal finances project. Now we're moving inside the retirement account, and that is where you're going to have your stocks and your bonds. Remember, for something so soon as emergency reserve or saving for a down payment for a house that's going to come up in a couple of years, you don't want that in stocks. It's just too risky. And so we're going to save the stocks and the bonds for for retirement, which is going to be for you a long time from now. So you see here, we're on the portion of the project that where the mutual funds are going to be. You need to and see where the cursor says in. Now we're inside the retirement account. So your first step is to tell me which are you. Are you play it safe? Are you middle of the road? Or are you aggressive? Because how you feel mentally, you don't want to be investing in something very aggressive if you're going to be worrying about it all the time. And if you're aggressive, you don't want to be uh, holding back and playing too conservative. So the first step is to see how you feel. So there's not a right answer to one of these three, but which one you pick will determine what your right answers are later for your proportions of stocks and bonds. Now we move into picking what percent. Remember, at this stage, you are, let me see, how old are you? 1 year out of college, okay? So we're still in the first stage. You're 1 year out of college. So let's say you're 22. You're play it safe. What percentage of your retirement account would you put in stocks and what would you put in bonds? So remember the benefits and the drawbacks of each vehicle. Stocks can earn you a lot more, but they're a lot riskier. So when you're young, you can afford that. You can afford the risk. So you're going to want to have much more heavily loaded on stocks when you're young because then you have time to recover, but you can get the huge growth potential of stocks. So if you look in your notes, there is a diagram, a table of how much you should put in stocks and how much you should put in bonds based on whether you play it safe, middle of the road, or aggressive. And I can just read it to you. So if you're play it safe, your bond allocation is your age. And then your stock allocation is everything else, which is 100 minus your age. So if you're just out of college, your age is 22, well that's how many you have in bonds. Then everything else will go into stocks, 100 minus 22. Then middle of the road. So if you said I'm middle of the road, how much would you put in stocks? How much would you put in bonds? Well, we'll start with the bonds. We say bonds will go your age minus 10. So let's say you're 40, then you'd have 30% bonds and everything else stocks, 70%. So just whatever your age is, minus 10, and then 100 minus that, everything else goes into stock. That's if you're middle of the road. If you're aggressive, you're going to take even more out of the bonds. You're going to take your age minus 20 for bonds, and then everything else will go in stocks. So 120 minus your age. So if you were 22 and you're aggressive, 22 minus 20, that means 2% would go in stock. Bonds, almost no in bonds. You're aggressive and you got a long time to recover if the economy collapses. Everything else, 98, would go in stocks. Be aggressive, take the risk, but if it collapses, you got plenty of time to recover. So that's what this is. What proportion is going to go stocks and bonds? Now, within your stock funds, notice how I've got stock funds and then bond funds. You're going to pick both. Within stock, we've got domestic and then we've got international. So it's hard for you to read this. Maybe right here it says percentage of domestic stock. I'll put into index. Percentage of domestic stock, I'll put actively managed. Remember we talked about the core and explore philosophy. So within your domestic, Okay, we're going to um, split that up. Most of what you want, most of what you have, you're going to put in your index. So we're going to put in here, I'll just go ahead and tell you what to put, 75%. So that means of all my domestic stock, three quarters, 75% will be in index funds because of the great advantages of index funds that I talked about in the lecture. Then we'll take 25% to pick some actively managed for some things we think might be able to do better. Now, in the real world, you don't have to do this again. Where do I think you should do your best getting ideas of what to invest? Talk to your parents. Okay, talk to your parents. If they've been saving for retirement for decades, they might have some good advice for you. So this is just one possible approach. Then, for international, what percentage should you put international? Well, this again comes down to how aggressive are you? Play it safe, middle of the road, or aggressive. So the guy I got these notes from, he's more aggressive than me, but this is what he said. He said, so here what we're saying is of all of your stock, how much should be international? And go ahead and get these numbers down. He says if you're play it safe, make that 20%. If you're middle of the road, make it 35. If you're aggressive, whoa, go 50% international. Because of all the opportunities there are for growth. America has seen so much growth already, and you got parts of the world where you're just bringing in capitalism and they're seeing so much growth. You can be part of that. You can reap part of that by having more international, but it's riskier. So there's more potential for growth. You got China, India growing 6, 8, 10% sometimes a year. America, we're happy to do 3 because we've already done so much growth, and those developing countries have so many low-hanging fruit to pick. There's so much opportunity for growth. You can be in there. But again, if you look at international at other countries, they're also riskier. So um, that's the number you need to put in there. That depends on how aggressive you are. Let me see. Okay, down here, and we'll get in a second what's going to go in all these boxes. I'll show you in a second. Now down here, bond funds. So these are both your bond funds. You're going to have index and actively managed. So index, we're going to do the same thing that Core and Explore. 75% go index, and then 25% go actively managed. That's of all your bond funds. Now's the fun part, and we're going to see who can do the best job. Who can get the best mutual funds? So where I encourage you to go, you can go other places. I found this useful. Schwab.com, SCHWAB, Schwab.com has a mutual fund screener that makes it easy to look stuff up for. So you could just Google Schwab. You see how it's spelled right here, Schwab. And then you say Schwab Fund Screener. So FUND, mutual funds, fund screener. It screens through them. Where's that written in here? There's going to be somewhere. Well, okay, so you just Google Schwab Fund Screener, mutual fund screener, and this will come up. So what this does is it lets you input the different characteristics you're looking for and then get the returns you want. So let's go ahead and supersize this bad boy. So the first thing we said, well, let's go partial. The first thing we said we were looking for stock, right here, stock domestic index fund. That's the first thing we're going to look for. Stock domestic index fund. So let's see if we can line that up. So we want, this shows you what's listed in the screener. Fund category, yeah, we want that. We want it to be able to pick of whether it's indexed or not. Watch all the things I'm checking. You want it to show, yeah. Yeah, so these are some good things to check. Not that concerned about the Morningstar and average return. Well, we'll keep average return on there. So we've got fund categories. That's the main thing you want to look at. What type of mutual fund are you getting? And we said we don't want international. We want, just double check here real quickly. Okay, sorry about the pause there. I thought there was a way to get to just show stocks, but I'm not finding that. So what I'm guessing is stocks will probably rise to the top. They tend to have high returns. So we'll just go ahead and run the screener, and then when we get it, we'll make sure it's showing stocks. So this right here determines what's showing up in the screener. And so I don't really care that much about Morningstar. I do want the fees to be one of the things we want to be able to look at. So if we have this selected, these are different options about fees. We want no load, no transaction fees. Remember, we wanted that, so it's only going to pick those. No load, no transaction fees. I'm not that worried about annual returns. We'll sort those out once we get them picked. Yes, you only want things open to new investors because why show funds that you can't invest in? And I'm not that concerned with gross expense ratio. We'll pick that up later. Maybe that could be helpful. And remember, we said we're going for an index fund. So I'm going to click yes, index fund. So remember, there's two types. Actively managed, you pay somebody to go buy good stocks, or index, you have some index and then the mutual fund automatically picks stocks based on what type of index you have. And we're going to start with an index fund. Okay, so let's see what this is going to give us by clicking View Matches. And remember, you can't pick the fund that I'm picking because you got to do it for yourself. I got to know that you actually did this. Okay. Now, we've got a whole bunch of mutual funds that are returned. How do we pick which ones? Well, what I'm mostly concerned about is long-term return. That's the big thing. Let's see if I can do advanced sort. Yeah, that's okay. I'm going to pick the column that says longer returns. Oh, you know what? I should have done this. Basic criteria. Let's go back. Performance. There we go. Sorry. That's what I was looking for. So over here, so you just follow what I'm doing. You don't have to go through all these steps. You can get automatically what you want. I'm more concerned about long-term, long-term performance. You can see ups and downs as well. Again, talk to your parents, see what they want to look for. That's what I'm looking at, the long term. And so I want to know, I want that to show up as one of the criteria when it shows me it's the stocks, the funds it comes up with. So I'm going to view matches. Okay, and now this is one of the columns. Remember, I asked for average return after 10 years. So after 10 years, how well is it done? That's what I'm interested in. So I'm going to click that column heading. It's waiting. Now it's got it oriented by, it's average 3-year return. And then let's look at the average 10. See, it goes average 10-year return starting here and going down. So wow. If you invested this 10 years ago, the average year, it went up 27.87%. Wow. That's pretty awesome. I'm not going to lie. And that's with the awesome bloodletting we've had lately. Again, this is May 2020. Although we did see the stocks rally a little, I've been trying not to watch it. Okay, so I'm saying that's the bomb diggity. I want to look at this one. So I'm going to click on the symbol, and that'll take me to the fund itself. There we go. Okay, so here is more details about that fund that did so well. Again, you can't choose it. This one's mine. Stay away. Okay, so now I got to fill in this. So this is the one I picked, Direxion Monthly NASDAQ. So that's a NASDAQ 100. Um, so what I would write here, index funds, a name of fund right here. I would write this, I would write that right here. Name of company, I'm guessing it's Direxion. Gotta find some word in there, usually a little more clear what the company is, right? Uh, web link, well, we'll just put schwab.com is where you got it. Now, here's the important information. Why did we choose this bad boy? We got to go a little deeper and make sure we do want to choose it. So let me help you look around to see how you find the information you're looking for. So this is an overall summary. This is a graph showing you if you'd invested in this bad boy in the year 2010, if you'd put $10,000 in, okay, what would it have done? In 2010, it started at $10,000. Look at that, right? By just around the beginning of 2020, that 10,000 turned into 150,000. Then it went down to 100,000. Okay, so even though there's ups and downs, right, still you're a lot better off here than you were back here. So that shows you how well it's done. And then you can look, well, we don't want to do it. We don't want to do it. Okay, let's look at 1 year. What did it do? Oh, chart unavailable. Good. That would look pretty bad. Year to date. Oh, good. We don't have to look at that. It's just depressing. Okay, so you don't want, that's why I didn't want to look at it. Okay, so now filling in the information. Let's look at performance. Not too bad. Not too bad. Look at that. 10-year performance. Don't know why this is different from what it showed at the front, but 30.74% annually. So what would I write in there? That's my 10-year returns. 10-year returns right there. 30.74%. Do you want this number to be high or low? High. That means you put in 10,000 bucks in a year, it's now 30.74% bigger than the next year. 30.74% bigger again, and it just snowballs, right? That the higher the better, and that is very impressive. 30.74. So you put that in there. 5-year, 27.23. Go right in there. 3-year, wow, that would go in there. Now, investors will always tell you past performance is not a guarantee of future success. But that's why I wanted to go. So there's no guarantees with any of that. That's why I wanted to go 10-year though, so I could know ups and downs it's tended to do well. So hopefully you understand now what goes in there. What we probably should have looked at first though, because it might be rule out the fund altogether, because I want these to all be no load. Let's look at, wait, no, not fund facts and fees. Yeah, fees. So fees, how much you're getting charged. And we don't want that to be high. So what fees are we willing to accept? Put it in the lecture, I think. Let's see. Well, I'll just go ahead and tell you. If it is an actively managed stock, generally, advisors are going to say, you don't want that to be, let me pull it out. I think I've got it here. Yep, here we go. So if it's actively managed stock fund, you'd say you want it to be 1% or less. So this is a little on the high side, right? 1.43. But man, with those returns, I'd probably be willing to take it. Problem is, most guys are not going to make up for that high expense ratio. So generally, because again, you can't predict the future, so just because it did well in the past doesn't mean it's going to do well in the future. So that high expense ratio is sucking out your returns. Generally, you'd want to avoid something this high, 1.43%. So you probably don't want to pick one this high, but man, that guy really, it rocked. Notice though, category average, other ones it's compared with that. Oh, and by the way, actually, I'm sorry, this isn't actively managed. This is index. And index funds really shouldn't be more than 0.5% because it's not like you have to pay anybody to do it. So that's really, really high. But it seems to be doing well. But yeah, I would not want you picking one like this. That is way too much to be paying for an index fund because remember, you don't have anybody making any picks. Also, we don't want a 12b1 fee. You don't want to have to pay people to take your money. Okay, so you want to avoid something like this. So I would not like this. Okay, I want this to be zero, so I wouldn't want these charges. So if you did pick this one, um, you would have to write for the 12. That's another word for a load. A 12b1 fee is a type of load. You'd have to write 0.25%, and I would not want that. I wouldn't want. I want that to be zero. Okay, remember, all I have to do, I've got the same website. You give me these names and make sure I can read these. You give me these names. I need to be able to look at this and make sure it's um, zero. And when I look, I know where to go to check this. Okay. Um, what have we not filled in yet? Operating expenses. There we go. That also is here. Operating expenses, what do they call it on this website? They call it gross expense ratio. Okay, so the expenses, 1.43, I want that to be lower. Again, I would like that not to be more than 0.5%, 0.5% for an index fund. So on this fees and expenses, you get the operating expense, this you put in there, and you get the a 12B. These are all loads. That's another type of a load. 0.25, that would go there. I want these to be zero, and this is where you check to make sure it's zero, and this is hopefully less than 0.5%. What else do we need in? Morningstar, that's somebody who ranks mutual funds, and I think that's going to be under performance. Let's see. By the way, why do they put the S&P 500 here? That is the benchmark. Remember in the lecture I talked about you compare with the benchmark because if your stock is down, you're like, oh no, it's down. That's horrible. Yeah, but compare it to everybody else. I mean, if the whole stock market is down, you might not be doing that bad. Look, down 3%, but the S&P 500 is down 9.26% for the 3 months. So if you and look at how much better it's done for the 10-year. It's for the 10-year, it's 3 times as good. So how you know you're doing, you don't just look at the number by itself because, well, what if everybody's up high? Maybe you're not doing that well compared to everybody else. Or what if everybody's low? Maybe you're doing better even though you've lost. That's what the benchmark is here to show you. So Morningstar ratings, let's see. Maybe it's on the summary page. Oh, Morningstar rating, not available. Okay. Well, no Morningstar ratings, but I think that's where you're going to find it is on the summary page. I don't know why Morningstar. It's a company that rates mutual funds, and hopefully we'll get that for the other ones. All we have left now is risk level. Main thing is performance, but if you have two that are both performing really well, we can look at risk. And obviously you would like your risk to be low. That's why we go to the risk tab, risk analysis. So and the best thing we can get here for risk is on this website, go to the beta. Beta is a statistical measure that shows a fund's volatility, how much it goes up and down. And you want the lower the better. So 1.96, that's fairly volatile. So you would write risk level 1.96. A 1 would be the S&P 500, I'm pretty sure. So that's pretty much up, that's pretty up and down compared to the benchmark. So that is your index stock fund. your domestic index stock fund, and make sure it's domestic. Um, that's something we probably should have done. Let's go back to the fund screener here. Ah, so we didn't click international specifically. So that might have given us international. I think that was domestic, but double check and let me show you where to look to make sure it is a. Okay, so we're back at that fund I'd looked at before. Summary. How can you tell if it's domestic or international? Likely it's going to be domestic. There's more of those. If you don't say domestic or international, it's probably going to be domestic. And later when we do the international, we'll specifically say, I want the international. But here, if you look at the fund strategy, read this and see what it says. 80% of its net assets and securities, index exchange fund. Okay, includes 100 of the largest domestic and international. So it's got a mix, but I think it's mostly domestic. It doesn't say it's focusing on the international. Okay, let's go back to the screener. Now it's time to choose an actively managed fund. Now the way we can, excuse me, I'm sorry. Yeah, we just chose index. Now let's pick an actively managed. Okay, so we choose, so you're over here, the basic criteria, you choose index, and now a little option. Yeah, that's how we could have chose domestic. When you're choosing, let's just show you one more time how you could pick domestic. So we've chose fund category, index funds, gross expense ratio, total return, 3-year, 5, fine. Um, Performance, I want the 10-year. If you choose, you could do 5. I'm looking at 10. Whatever you pick here, that's what's coming into the screener, and then what will show up in the columns that you see later. Okay, so if you want a domestic fund, excuse me, if you want to make sure you've got an index fund, you can choose yes, index. If you want to choose actively managed, hit no. And that's what we're going to go with. I'm sorry, I was saying international. We're talking about index or not. So the first one we did index. Now we're doing actively managed. We can make sure it's actively managed by saying, no, I don't want it to be index. Okay. I think we've got everything we're looking for. Yeah. Yep. Okay. We'll look at those matches. Let's see if we've got everything listed. Open new investors. No load. Okay, let's see. Okay, now let's scroll over to get the column we're looking for, which was the 10-year return. Yep, there we go. Okay, 10-year return, average annual 10-year return. There we go, 15.11. Morgan Stanley, 15.11. Not bad. So let's go in and get all the data we need. Ugh, I don't want to see. I don't want to look at it. Okay. So again, if you invested $10,000 in 2010, it would now be worth, uh, was that 45,000, something like that. Okay, 40,000, 45. Yeah, right here, basically 40,000. That's compared to, and here are your benchmarks. If you put that in the S&P 500, it would be 26,787. But hey, still doubled in 10 years, right? Almost, doubled and a half. So, but if you'd been in this bad boy, you'd be doing, see how much better you're doing than the S&P 500. Okay. So now let's find the information so what would you write? Well, let's find fees to make sure we're not going to cancel this one out because of the fees. We're going to find the operating expenses. Remember where I said to find that? And again, you can't use this one. This is mine. Pick your own. Get your own fund. Expense ratio 0.85%. So that goes right there. 0.85. Yeah, that's below 1. That's good. That's acceptable. Ooh, well, we don't want these loads. So you'd have to write 5.25. That's something you have to pay to get into it. And then a fee, I think, to pull out, 12B1. You'd have to write those in there. So I wouldn't want you picking these because I don't want any loads. Now, when you do that in the real world, just talk to somebody you trust, dad or mom or somebody who does investing, and say, are you okay with it? For the project, I want things to be none. Returns. So if we'd found one that was zero load and decent operating expenses, below 1 for an actively managed, below 0.5 for index, let's go ahead and get all the information we need. So now that I've checked it, the name of the company is Morgan Stanley. So you'd write that, name of company. Name of the fund, Morgan Stanley Institution and Fund Growth Portfolio Class A. That would go in there, all that. Web link, just put schwab.com. Now we're going to look at the returns. We'll go to performance. Not too bad. So here's where you write in the 10-year. There's your 5, and there's your 3. Put those in here. Right there. Returns. Oh, sorry, wrong one. Actively managed. Morningstar ratings we'll get to in a second, but again, compare with the benchmarks. This is large growth, the type of fund it is, all large growth, and this is S&P 500, and you can see beating them handily. It's like double the S&P 500 over the 3-year. Morningstar ratings, let's see, that would be, let me see, is there anything else we want in this one? I think we said that was on the front. Risk level, let's get that. That's the beta. Huh? So it's less volatile than the S&P 500. It's only a 0.88, so you'd write that in risk, 0.88. It's fairly stable. And then summary is where we get the Morningstar ratings. There we go. So not too bad. 3, 5, 10-year, and overall right there. So how many stars you get? 5 stars. And then it's got the 3, 5, and the 10. All 5 stars. Bam, bam, bam. You know what else you can put for? You know what? How much you can do this instead? Instead of the beta, which is a little, what exactly is that, right? Use this high risk level. So you got high, you've got low, you've got medium, and then in between you got medium high and medium low. Okay, so use this instead of the beta. It just makes more sense. It's more common sense. So you would write in here high. So with great rewards comes great risk. But yeah, these often go together. It'd be nice if we could see this up here and this not so high, but it's often that way. Let me see how much time I got on this. How much we got left? Yeah, okay. I don't want this to crash on me. I'm gonna go ahead and stop this lecture. We'll have one more leading you through the rest of the project.